the last discussant, Wolfgang Munchau from the Financial Times.
Thank you very much. I'm going to speak from here. I'm going to pick up where Jeff left. I actually disagree with him on 2 points. The first thing is on his prescription. I don't think that the crisis was primarily a fiscal crisis except in Greece, and for that reason I don't think we should spend too much time worrying about optimizing our fiscal crisis institutions and mechanisms. It failed in Greece, and it failed because for a number of reasons. It's a very small country. If it had only been Greece, we would not have even be discussing this story. And actually, I disagree with you on the ostrich, because it's actually a lot worse. Because you assume that there is an ostrich that could put his head in the sand. The political economy of the Eurozone is actually quite toxic. If you think about the Eurozone pre-99, there were 17 small open economies. These small open economies join, and what you create is a large closed economy. The mistake that we probably all made in terms of figuring out how it would behave is that when the finance ministers of these 17 open economies come together, you have 17 open economy finance ministers, and they come together and talk about things like competition and competitiveness, and there isn't an ostrich who actually thinks of the thing as a whole. They have a head finance minister, but he has no power. The European, as Gordon Brown was saying, the first time the Eurozone leaders actually met was not until 2008, and it was actually at that meeting in 2008, a month after the bankruptcy of Lehman, that the original sin of this crisis were actually committed. And the original sin of this crisis was that they met, I think it was in Paris, they met and decided that they want to backstop the financial sector, but not do this together, but each country by itself. So the banking crisis thus turned into a sovereign debt crisis. So the fiscal crisis that we got was the result of the way we handled the banking crisis, and we handled the banking crisis in the true spirit of small open economies. I recall the German finance minister at the time saying, "No, we don't want a European solution because it would impact the competitiveness of the German banks." Just imagine the pettiness of the argument. It would have been a lot cheaper creating a European bank restructuring fund back in 2008 that would bankroll provide equity to the banks in trouble. The Landesbanken, the Cajas, HRE, and various other banks would now be in European hands. They would be regulated at EU level. They would be, and any further actions would also be taken at EU level. Where we headed in this situation from now is, this is a very complicated starting one. I mean, this is really the Irish joke. You wouldn't want to start from here, but we have to. The way I see this crisis developing is actually that the key question is, will we, in this interim period, while we have the temporary mechanism, will we recognize the default or will we not? If we do not recognize, and my guess is that we will not recognize the default. The ECB is very hostile to this. The finance ministers are actually opening up to the idea of a Greek restructuring of bonds. There was a phone call, a conference call between finance ministers and Trichet last week, and Trichet told them, he gave them orders essentially, that a default would not be possible, and they have actually backtracked. It might happen, but my guess is that because of the extreme hostility of the ECB and because of the electoral timetable, because default is slightly risky for incumbent politicians, because it may create a chaos for which they might be held responsible. And there are elections in all the 4 big countries in the next couple of years. So my guess is they will try to push the default. They will try to kick this down the road and push default beyond 2013. Now, an interesting situation will arise then if you assume that default would then be possible in 2013, then I suspect the next generation will try to kick this down the road again, maybe another year. And by that time, you will probably find that the ESM will have bought up almost all the debt of the periphery countries. A large amount of that debt will then be held by the bailout institutions. And then you come to a situation where they either default down the line and this thing just blows up in a big way, or, as I suspect, what we are more likely we get this scenario where they will try to bankroll them forever. There will be new loans on top of old loans, bad money thrown after good. Loans will be lengthened, maturities will be lengthened into eternity. in order to avoid default. The EFSF, or the ESM by that time, will then become the Eurozone bond. It won't be that neat Eurozone bond that your colleagues at Bruegel had proposed, the nice bond that could compete with the US Treasury market. It would be a very toxic Eurozone bond. But the EFSF's own bond, it will be a AAA rated bond, but the southern European countries will be off the capital markets essentially in perpetuity. An alternative scenario could happen that there is a political revolt in those countries in the interim period. It's not entirely excluded. Judging from Kevin's remarks, the anger in Ireland is building up. The referendum in Iceland, rejecting the ISAFE deal, also suggests that if this had any impact on Ireland, and if Ireland also wanted a referendum on any of these matters, it could go horribly wrong. There's political resistance in Greece to a lot of the austerity measures already introduced. In Spain, the austerity program starts with a level of 20% unemployment. It will rise in this process. My own guess is that Spain is actually, I'm not saying very likely to become the next country to fall into the mechanism, but I think there is a certain probability that, given the state of the housing market and the interaction between the housing market and the banks, and the fact that the housing market hasn't really deflated nearly enough as I would expect it to, given the extremely strong bubble, which was not a lot less than that in Ireland. My guess is that Spain will at one point suffer from a liquidity problem, at least, that it will need to refinance the banks to a tune that it might not have funds for, and might therefore need to ask the EU to help it out, and the EU would then create a special program to help Spanish banks. Coming back to Kevin's triangle, so we have that is really the choice that we will have in these two scenarios. We are actually it's very un-European that we're dealing with very stark scenarios. It either brings us to some breakup, or it brings us to some form of quite extreme fiscal union that we create. We will not have those middle options, and that's precisely because we didn't allow these various rescue mechanisms to have the flexibility to purchase bonds, to act on the primary markets. We deprived them of that, and that is the reason why we are acting we are heading into a bifurcation of the system. And I think that's when you look at Kevin's triangle, his letter triangle, it will be either the nation state or the fiscal union, and it's impossible to forecast how this will turn out to be. Thank you.